Ever wondered what terms like Assessee, previous year, or assessment year mean under the Income Tax Act, 1961? Well, you've come to the right place. The Income Tax Act of 1961 is not just a piece of legislation, it's the foundation of India's taxation system. It's a vital tool for finance students and professionals alike. Over the next few minutes, we're going to delve into the heart of this act, shedding light on the key terms that govern our tax system. We'll take a closer look at what it means to be an assessee, how the previous year and assessment year impact your tax liabilities, and the various sources of income and heads of income that form the basis of your taxable income. We'll also demystify the terms gross total income and total income, and how they come into play when calculating your tax due. Now let's dive into these terms and unravel their meanings. Starting with the very first term, assessee. An assessee, in the simplest terms, is an individual or an entity who is liable to pay taxes to the government under the Income Tax Act of 1961. But let's delve a bit deeper. There are different categories of assessees: an individual, a Hindu undivided family, a company, a firm, an association of persons, or a body of individuals, a local authority, and every artificial juridical person. Each of these categories has specific tax obligations and benefits under the Act. So who is an assessee and what category they fall into has a direct impact on their tax liability. To sum up, an assessee is a key player in the income tax landscape. It is the person or entity that the Income Tax Act holds responsible for paying the tax. So, in a nutshell, an assessee is the person who is responsible for paying the tax. Moving on to the terms previous year and assessment year. These two terms are crucial in understanding the timing and process of income tax calculation and payment under the Income Tax Act of 1961. So, what exactly is a previous year? It's quite straightforward. The previous year in the context of income tax is the financial year in which you earn an income. A financial year runs from the 1st of April to the 31st of March of the following year. For instance, if you earned income between the 1st of April 2023 and the 31st of March 2024, then 2023 to 2024 is your previous year. Now, let's unpack the term assessment year. The assessment year is the year immediately following the previous year. This is the year in which your income earned in the previous year is evaluated and taxed. Therefore, if your previous year was from April 2023 to March 2024, the assessment year would be from April 2024 to March 2025. But why is this distinction important? It's because the Income Tax Act follows a system known as pay as you earn. This means that the tax on income earned in a particular year is payable in the subsequent year. So, you earn in the previous year and pay tax in the assessment year. Understanding these concepts is vital as it helps in accurate tax planning and ensures compliance with the law. It assists in identifying the appropriate year for claiming deductions, allowances, and reliefs. Also, it aids in determining the correct rate of tax applicable for the year. Therefore, the previous year is the financial year in which the income is earned, and the assessment year is the year following the previous year in which this income is assessed and taxed. Next, we have sources of income and heads of income. Let's start with sources of income. This term refers to the origin of your earnings. It could be your salary, profits from your business, or returns from investments. It's where your money comes from. Now, let's move on to heads of income. The Income Tax Act 1961 groups all possible sources of income under 5 distinct categories or heads. These are 1. Income from salary. This includes wages, annuity, pension, gratuity, fees, commission, perquisites, profits in lieu of or in addition to salary, and advance salary. 1. Income from house property. This refers to income earned from a property owned by the taxpayer. It could be rent received, or the estimated rent if the property is not let out. 1. Profits and gains from business or profession. This head covers income earned from a business or profession, including profits from the sale of goods or services. 1. Capital gains. Income derived from the sale of a capital asset such as property, stocks, or bonds falls under this category. 1. Income from other sources. This is a residual category that includes income not covered under the first 4 heads. It could be lottery winnings, dividends, interest on securities, etc. These 5 heads of income play a pivotal role in determining the taxable income. They help segregate income based on its source and nature, making it easier for taxpayers to compute their tax liability accurately. Remember, not every source of income is taxable. The Income Tax Act provides certain exemptions and deductions, which could reduce your total taxable income. So, it's crucial to understand these heads of income and where your earnings fit in. In the end, it's all about knowing your income, understanding where it's coming from, and how it's classified under the Income Tax Act. Once you've got this down, you're well on your way to managing your taxes more effectively. So these 5 heads of income provide a comprehensive categorization of all possible sources of income. Finally, let's explore gross total income and total income. These are fundamental terms in the world of finance and key components of the Income Tax Act of 1961. Understanding these terms is essential, not just for finance students, but for anyone who wants to make sense of their income tax. So, what exactly is gross total income? It's pretty straightforward. Your gross total income is the collective sum of all your income from every source, falling under the 5 heads of income. These heads include salaries, income from house property, profits and gains from business or profession, capital gains, and income from other sources. Add all of these together and voila! You have your gross total income. Now this is where it gets interesting. Total income is not just a fancier name for gross total income. No, it's a bit more nuanced than that. Your total income is your gross total income minus any deductions and exemptions you're eligible for. The deductions could be anything from savings under Section 80C to interest paid on education loans, and exemptions could include house rent allowance or leave travel allowance, among others. So if you're thinking that gross total income and total income are just 2 sides of the same coin, think again. They're 2 completely different entities with their own unique characteristics. The gross total income is like a bird's eye view of your income, whereas the total income is a more precise measure that takes into account various deductions and exemptions. Why is this important, you ask? Well, the total income is the figure that the Income Tax Department looks at when determining your tax liability. So, knowing the difference between these 2 terms can help you understand your tax obligations better and even plan your finances more effectively. So, gross total income is the aggregate of all incomes under the 5 heads, and total income is the gross total income minus the deductions and exemptions. Simple, right? But remember, understanding these terms is just the first step. The real challenge comes in applying this knowledge to your own finances. Let's recap what we've learned so far. We started our journey with the term assessee. Remember, an assessee is any person who is liable to pay tax or any other sum of money under the Income Tax Act. This includes individuals, Hindu undivided families, companies, firms, and more. It's crucial to identify the assessee correctly, as it forms the basis for tax calculation and compliance. Next, we looked at the previous year and assessment year. The previous year is the financial year in which the income is earned. The assessment year, on the other hand, is the year following the previous year, in which the income is assessed and taxed. These terms help in establishing the timeline for income generation and taxation. Then we moved on to sources of income and heads of income. Sources of income refer to the various ways in which an individual or entity can earn income. These can range from salary to business income and from house property to capital gains. The heads of income is a classification system under the Income Tax Act, which categorizes income into 5 sectors: salary, house property, profits and gains from business or profession, capital gains, and income from other sources. Understanding these sources and heads is key to determining the taxability of income. Finally, we delved into gross total income and total income. Gross total income is the aggregate income under all 5 heads, before any deductions. Total income, however, is the gross total income minus permissible deductions under the Act. These 2 concepts help in ascertaining the overall income and the taxable income of an assessee. And that's a wrap on the basic concepts and definitions under the Income Tax Act, 1961. Remember, understanding these terms is crucial to navigating the world of income tax. So keep learning and stay financially savvy.